Howdy there, folks. Welcome into today's video on the reaction channel. Two for me to react to in this one and give my perspective on, okay? It's a buy one, get one free. First one up here, the jobs data gives the Fed reason to table rate hikes this month. This is an important subject. I got really strong opinion on this one, okay? Because I'm hearing some chatter out there. And I want to share my thoughts on that one. Really strong opinion I have in that one, okay? Second video I want to react to is this one. Liquidity has been a tailwind for stocks this year. I want to hear what Cameron Dawson has to say in regards to this and kind of give my opinions and perspectives on what Cameron has to say there. I appreciate everybody joining me. As always, thanks for being subscribed. Folks, we are now at 27,800 plus subscribers, a new all-time high. We might as well call this channel Meta Stock. I appreciate y'all joining me as always. By the way, Meta's not back to an all-time high. It's at a 52-week high, okay? All-time high maybe later this year. I appreciate y'all joining me. If you're looking to apply for my private group this week, I invite you to apply. That's going to be pinned comment down there to fill out an application, okay? Let's go.
On the household survey, I wonder what Michelle thinks of that. I'd give her a chance to chime in just a second, but I will say I like the way you set it up. There's some good and bad stuff in there. Look, anytime you're going to put more Americans to work, it's a good thing. We maintained the participation rate. The wage growth was a little bit less. So all of that, I think, was pretty positive. And the market is taking it pretty well. They really took to heart. I don't know if I want to call it the Jefferson pause or the Harker skip. What's the right way to put it? I don't know who deserves it. It's really something I think that ultimately came from Powell, but I think Jefferson is the one who's going to be tagged with it. So really no change at all in the outlook for the Fed, despite a high headline number. The revisions, of course, also were in the way of higher numbers. So that tells you that there's still real momentum in the job market.
Michelle, what do you say?
Yeah, I mean, Steve, so much of what you say was what I would echo. We were looking at that same statistic, the adjusted household number that aligns it more with the establishment survey that always gathers the headlines. And actually that household measure adjusted was up even more in this month than what the payroll number showed. So, but there were other areas. The hours worked numbers were a little bit weaker. I think the earnings numbers, of course, getting a lot of focus. I mean, if the labor market is strong, but you're not seeing the wage pressures coming through from that, then that gives the Fed more room to take this pause. So, I think that's, where we'll come out. There's enough in this report that doesn't force the Fed to have to move this month. They can, and we even think the CPI numbers are going to be somewhat troublesome for the markets. We think this will be probably the last high print, but we've got a relatively high core rate expectation.
Last high print? Okay, so two important things I want to touch on here, okay? First one is, are we really that convinced that CPI is going to be hot, okay? If we go to truflation, right, which obviously truflation numbers are always going to be a little different than the government numbers. And once again, truflation had us back at 11% plus inflation last year when Fed only had us, the government numbers only had us at 9% or so, okay? But the bottom line is, truflation numbers for most of the month of May, okay, which is what the numbers are going to be coming out in June in about 10 days from now, roughly, 10 days, something like that, right? For almost the entire month of May, we were in the threes. And at the end of the month, we actually slipped down to the twos. So I would say there's an extremely high probability CPI comes in as something with a 3 in front of it for the month of May, right? The numbers that are coming out here in about 10 days or so. That's the first thing to understand. And I think that's very important because clear as day, the trend is down for inflation, right? And so the second component is a lot of people are saying, well, jobs numbers really good right now. Markets holding together really strong. Housing is, okay. So a lot of people are looking at all this and they're saying, why shouldn't the Fed keep raising right now, right? And not take a pause. My stance on that is, why did the Fed ever start raising rates in the first place? It was because inflation kept going up month after month after month, and it was clear, this is going to be a problem, right? So now Fed funds rates is substantially above likely whatever CPI is, because CPI right now is probably high twos, low threes in reality right now. Fed funds rate is 5% plus right now. So why in the world would the Federal Reserve keep raising rates when it's clear as day the trend is down, right? It doesn't mean the Fed has to lower rates right now. They can save that for if they see some economic weakness in the back half of this year or something like that. If they see something there, jobs report comes in really bad, then they can start lowering rates, especially if CPI is heading our way. But why would you keep raising? It makes no sense. Then you're just asking. To try to devastate the economy. And for what? For what? So then you can spend trillions of dollars saving the economy, because that's exactly what's going to happen if they had to do that. So then a bunch more banks can go under and you have to save the day there? Doesn't make sense, especially when CPI is likely about to come in at 2s or 3s. So, put the pieces together there, and that's a very frustrating thing I'm hearing talked about out there, and I'm like, it doesn't make any sense. People are getting very confused now at this point in time, the difference between economic numbers and inflationary numbers, okay? The Fed tries to control inflation, not is the jobs report too good.
And even with that, though, we think the Fed ends up skipping this month, but setting the table for action in July.
Michelle, I know people come to you and probably to me too and say, I need an answer now. But my answer is I really can't tell you now. And because the reason is when we have had these bumps up in unemployed people, folks, if you have that chart of the difference in the unemployed month to month in the back there, what you'll see is it looks like a sawtooth pattern. We get a increase of the unemployed and then it seems to go away. So maybe this last one, which is bigger than the prior ones of the month, you can see there, maybe this is the beginning of something, but certainly that pattern is not a recessionary pattern, Kelly, when we have an increase in unemployed and then they come back and they go away, then they go down and up and down. We can't make a call. Maybe in a month or two I can make a call. That may be late for you to make a call and this is a recession, but I can't do it from the data.
Michelle?
Well, and that's why we look at the employment survey or the establishment survey as opposed to the household numbers, right? Because they are so volatile month to month. I think too, when you step back, there isn't a lot to corroborate the weakness in the household numbers, in the sense that we haven't seen claims jump up. There hasn't been other evidence that you would have expected to support that weakness in the household survey. So I think all of this together has to have you leaning to the fact that the labor market still has a lot of strength, notwithstanding that jump in the unemployment rate.
Michelle, one thing that we can give people a beat on, I don't know if you've had the same experience as I have, but using the high frequency data, it's not always right, but it's been giving a good read of upside and downside surprises. And I'm talking about UKG and I'm talking about Homebase. Even ADP has done a good job of telling us not the level of employment. So that is something that if you listen to our reporting during the week, I know Michelle picks this.
That's for the 1% of macroeconomics nerds out there. There you go. Okay.
In her previews that we're giving people an idea of, is it tending towards the upside or towards the downside? And what we've not been able to do, because some of this data is so new, is to calibrate it to an actual level of employment growth.
But we had the same, reaction in terms of those ADP numbers, for example. The fact that, the way that the measurement has changed has seemed to have given it's just given us a really good lead on certainly the direction of the payroll numbers. It's been a lot more reliable. So as this kind of gets back to what we were saying, looking through, it is obviously a lot of noise in this number. But if you step back in more holistically looking at all of the labor market indicators, they do tend to still point toward more strength, not much sign of a sharp moderation.
Do you then think, Michelle, this is kind of a debate we've been having all day long, but it's really the whole debate in the markets. Do you think that the Fed...
See how well her makeup's done in terms of how it goes there?
It's done, or do you think that even if they skip, that there could be a lot more hikes, or you know what I mean?
And then look at the difference in the tone of makeup here, folks. Compliments of owning an elephant on a stock for a while.
Our forecast, and Steve, you remember, we had this debate going.
I can now point out if makeup's done well or not well.
The last meeting where our forecast has really been that the Fed can be done because we do think the economy is going to weaken as we move toward the, later in the year.
No disrespect, but just Michelle's probably been outside. Michelle's probably been outside a lot.
Last meeting.
Last weekend was Memorial Day weekend, probably getting tanned up, right? And so maybe usually your skin tone is something around this. so she doesn't have another makeup blend. And so she puts that on, but then it's a difference in color there. Okay, there you go. All right, next video up here. Liquidity has been a tailwind for stocks this year.
Thinking about this, I mean, the jobs number today, certainly strong on the headline, but enough slowdown internally to make people think the soft landing is not out of the question. The Fed's told us in the last few days, perhaps they're willing to skip, even with the economy strong, skip a rate hike. And, you know, we had the tech leadership, and now maybe it's starting to broaden out. So what's wrong with this picture?
Well, it certainly is encouraging that for the first day in a really long time that the rally isn't just a handful of tech names.
Cameron Dawson, 10 of 10 in terms of makeup done there. Very, very nice.
And to see names like Caterpillar up 7-8% today, energy stocks up 3%, that's really encouraging and a sign that maybe this
Yeah, there was some massive moves today, guys. Did you see some of these moves in some of these more like dividend-related stocks? Check this out, okay? This is insane. Look at Nordstrom today, a 9% move in Nordstrom today. Revolve stock, well, Revolve's not a dividend stock, right? And that one had been getting destroyed, and finally it's doing something. I mean, you know, we'll see what happens there. But yeah, Nordstrom just a massive move, 9% today. TPR almost 7% here today. Cheesecake Factory almost a 5% move today. I mean, some of these moves in some of these dividend stocks win a 4% move here today, right? Epic moves in many of these stocks. So anyways, I thought that was really interesting. You know what else was pumping huge today were housing stocks. Check out housing stocks. Look at some of these moves here, man. And some of these housing stocks are dividend plays as well, right? Look at Caterpillar, 8.4%. And obviously Caterpillar is way more than a housing play. I just kind of lump it into that construction, right? URI, United Rentals, 6.5%. Stanley Black & Decker, 6%. John Deere, 5%. By the way, something random. Did you know John Deere is one of the most beloved brands in the whole United States of America? Like one of the most trusted brands. I was looking at this brand list recently. I was shocked I saw John Deere on there. I was just like, wow, that's one of the most like beloved brands in the whole United States of America. That's interesting.
Having a very sharp slowdown in the very near term isn't happening, supported by the economic data we got today, as well as the China stimulus. And I actually think that is what's behind a lot of these moves in the cyclical names, because if we see more economic support out of China, good for commodities, good for these value names that have been really beaten up and really left for dead all year long.
They have. I mean, there's a way of describing what's been going on this year as taking the main complaint of the last few months, which is it's been an incredibly narrow rally, the upside driven by just a small handful of growth stocks, as saying, well, that's the market's way of kind of pricing in some slowdown risk into the rest of the market. Other sectors have not done a lot, therefore expectations are low, and if the economy's firmer, they can start to take up some of the slack.
Yeah, I mean, look at that equal weight index trading at 15.5 times earnings. Yeah. That's not pricing in anything aggressive. However, if you look at the growth sector or the technology sector, you're trading at 26, 27 times earnings, and you're actually back to territory that we've only seen those valuations when the Fed is actively easing. And so there is a point that some of these technology stocks, in addition to AI optimism, they have been pricing in a weaker economic environment and easier Fed policy. I think what's interesting about the Fed's commentary, even this backing off of a hike in June, is that even the most dovish members are not talking about cuts. And so it will be interesting when we get into the June meeting how they parse that gap between what the bond market is saying they will do and what they're saying they will actually do.
Right, but they can't talk about cuts yet. Why can't they talk about cuts yet? I think that's an important subject that's not talked about, okay? I'll tell you exactly why. The Fed cannot talk about cutting rates yet. They will be able to very shortly, as in the next few months, but they can't talk about it yet. The reason is because at the end of the day, CPI has been too high. Now, if we're starting to talk about 2s and 3s, that's a moment that the Fed can start actually talking about cutting rates. Fed funds rate barely got above CPI recently. The most recent government numbers that are obviously way backwards looking came in at 4.9%. Obviously, Fed funds rate's well over 5% right now, right? Finally, we got Fed funds rate above CPI. That's huge. Now, the bigger that gap gets, the more likely the Fed is to start cutting rates, especially if you tack on somehow jobs numbers coming in weak at the end of the year, something like that. A reason, other than inflation falling, that the Fed can say, you know what, we got to start cutting rates. And the market could be looking forward and saying, you know what, we think the Fed's going to, be cutting rates sooner rather than later, as in meaning the next 6 months.
They're going to have to.
Is it, by the way, good question. Is it impossible? Am I asking myself a good question? Is it impossible for the Fed to raise rates this year? Lower rates this year. I don't think it's impossible at all. If true-inflation's accurate and these numbers start coming at 2s and 3s, one bad or 2 bad months of economic data, boom, Fed's lowering rates. It's that simple.
Date their economic outlook to account for the fact that the economy is not slowed down as much as they might have thought. What it means for their target rate for the Fed. I guess right now the market's just saying, look, we're in the zone of where they said we're going to get to. There's some relief in that. But how would you be looking to either participate in what's going on or, use it, let's say, even to get more defensive, or how to navigate it?
So we have been buying equal weight and value. That's where if we're looking to put new capital to work, we've been focusing on those parts of the market instead of chasing the growth rally. If you look at growth in the NASDAQ, it is overbought in the short term. Now, momentum in the short term doesn't mean that the trend upward is over. It just means that you might have a little bit of a digestion period. So instead of chasing that today, we've been adding capital into the equal weight and value indices and actively purchasing names in those areas with a lot more valuation discipline.
And I guess the question is, what's the next thing? We seem to be kind of hopscotching from one thing we're worried about to the next, right? It's either, we're headed right.
I'll tell you exactly. I'll tell you in a moment. Hold on.
Recession, or the numbers were too hot in January, the Fed's going to have to go to 6%, and then it was debt ceiling, and then it was maybe an earnings collapse. A lot of them we've managed to weave around. And then, of course, now we have folks saying, well, now that we have a debt ceiling deal, it's going to be a big, huge rush of Treasury issuance, and what's that going to do to yield? So, in a way, it's good to have the wall of worry in place, but what do you think is the next thing to challenge this market?
I think it is exactly that last point, which is that we have seen liquidity be a very big beneficiary for stocks this year because of the drawing down of the Treasury general account. And Dan Clifton over at Strategas calls it Yellen's bazooka, meaning it's bigger than QT. It's actually offset all of QT this year, this spending of cash by the Treasury. And so when that reverses in the other direction, you lose a tailwind for this market. And it helps to explain why valuations are so high for growth in tech stocks, because they benefit the most from that liquidity. So as you pull that liquidity away, you see a rebuild of the cash balance that could be an important headwind and a source of rotation from growth into value.
No, the next thing that will scare the market and get everybody freak out, you wait on this. This is what it's going to be, okay? What's going to happen is, let's say unemployment numbers keeps coming in super low. Let's say earnings start picking up as the back half of this year goes along, which is definitely a real possibility. And it's seen as, oh man, the economy's not going to face that big recession that everybody was calling for, okay? Then what's going to happen is everybody's going to say, watch out, inflation's about to come back. And if all of a sudden you get 2 or 3 months, let's say at the end of this year going into 2024, where actually on a year-over-year basis, CPI starts going up and up and up, that's a moment where the bears are going to start saying, guess what? Inflation's back. The Fed's going to have to raise rates 6, 7, 8%, right? That's going to be the argument. That doesn't mean that's going to happen, but that will be the talk. And that will be the next bearish perspective and the next thing to freak everybody out, okay? I appreciate everybody. And by the way, the recession thing, they'll just keep pushing that out as long as they possibly can. Q1, Q2, back half of 2024. I appreciate everybody joining me as always. Make sure you're taking advantage of deals out there, folks. If you're looking to take your investing level up to the next level, learn everything I know and I've learned over the past 15 years as far as my knowledge, and get all access to all my courses and things like that, check out the pinned comment down there. That will be to apply to join my private group with the 6 and 7 figure members. Much love as always, and have a great day.